So much for joining us. Today is the last session for Get Money Smart at Lindenwood this year. So we're excited. It's been an awesome series and we're excited for what's in store today. Just a few quick housekeeping things. If you're new, if you're joining us online, welcome. And if you haven't been to one of the sessions yet, we've got a quick quiz that you can take, and I don't have the clicker. Hang on, a little technical difficulty. If everybody could just take this short quiz, if you haven't done it before, please do that. You can just scan the code or hop on. I'll give you a second to do that while you're getting that. Well, you're in for a treat today. I'll maybe just go ahead and introduce a bit while we're waiting here. We have two of our outstanding students from right here in the Placer College of Business and Entrepreneurship that are going to be leading our discussion today about investing basics. And I think you're going to be in for a treat. And I think walk away with a lot of practical advice. There we go. Again, while you're doing that survey and whatnot, there's a whole host of events going on around the region that Lindenwood has been a part of as well. These events are a part of this and open to the community called Money Smart St. Louis, which is going on all around. So you can go and check out other kinds of events happening. And without further ado, I'm going to turn it over to our awesome presenters today, Greg Knight and Hannah Bransetter, and I'll let them introduce themselves. Hey, we got another one. So you guys get more applause than anything.
Well, thank you so much for that introduction, and thank you all for coming out today. As Dr. Black introduced, my name is Hannah Bransetter. I'm a sophomore here at Lindenwood studying finance and economics.
You're studying just Bachelor of Science in Finance, and I'm a senior. So
So hopefully you guys are enjoying some ice cream and get to learn a little bit more today about investing, kind of how to get started and help kind of declutter all the information that's out there about investing.
So that kind of disclaimer is that we are not professionals in this, and we just take this with a grain of salt. It is not saying that you have to do this. It's just our own personal opinions on this. We just have to say that just to preface this.
Yeah, this is purely educational, giving you the information, giving you the foundation to start investing. And so to kind of gauge where you guys are at with investing, if you can, please scan this QR code. It will take you to menti.com, and you can just type in one or two words that quickly come to mind, just to kind of what do you think of when you think of investing. I will go ahead and pull up. So the QR code will also be on this. So we can kind of see what you guys. Okay, yeah, stock market, stocks, money. Very good future. Yeah, these are great. So that is the thing about investing, is it can be a little scary. It is complex. There's a bunch of information out there. But also, as you can see, it has to do with money. It has to do with building wealth, and kind of what we'll get into on this next slide.
So from noticing from the previous answers, I noticed it was from very simple to very complex stocks put options. What is investing in general? So for me, my personal word I think of is security, and it's a pun intended because I'm investing in securities to create a lifestyle that I want for my retirement. And it's pretty much just putting money to work for you rather than you taking home a paycheck and then just having that sit in a savings account. Investing works through many outlets, and we're going to go further into that.
So many of you said the stock market when you thought of investing. That was me as well when I first considered investing. Honestly, I thought it was the only option to invest in. So we thought we would kind of just touch base on that right off the bat of this presentation. It is essentially just an exchange where you can buy and sell ownership shares in companies. This gives you investors a claim on a portion of the company's profits. So you can earn income from these stocks through dividends, which is just earnings that the company pays out to its investors, mostly on a quarterly basis. And then also from fluctuations in stock price as it appreciates in value. Some key determinants of these fluctuations will be supply and demand of the stock. The stock market is a very forward-looking platform, so it kind of just gauges where investors see this stock going and how they value the future performance. Now, valuation gets really into the weeds. You could teach a bunch of classes onto this, so we won't get into that in this presentation. But an underlying factor will be financial performance. Is this company making profits, and are they making decisions that will help them to continue these profits into the future? So those are some more firm-specific factors. There's also economic factors that impact stock prices. A good example would be the COVID-19 pandemic. That was an overarching economic event that affected all of us from the slowdown in the economy and therefore the fall in stock prices.
And when to start investing, I think it's like growing a tree. What's the best time to plant a tree? It was yesterday or 20 years ago, because you would see it's beautiful. But you must invest in whenever you as soon as you possibly can and safely. Because when you're going into this, you want to have an emergency fund going into any type of investing. Get your spending under control, as is mentioned in previous lectures here in this hall. It's just control your spending first and get that in order before you start investing, and create an emergency fund first built off of. Because you don't want to put money into an investment account and just have it be pulled back out in a time of distress. And that would just be kind of pointless to have. Is just make sure that's always the base and the first start of what you do.
And then another key component, well, this has some varying factors, will be to pay off high interest debt. A concept that comes to mind for me when I'm trying to make this sort of decisions is the concept of trade-offs. So kind of just looking at what returns you could be making with your investments compared to the interest rate that is on the debt that you're incurring. For example, credit cards, those carry very, very high interest rates, 20% or more. So if you're carrying a balance on these cards, there's very few, if any, investments out there that I would personally feel comfortable earning 20% or more returns on average. So credit card debt is certainly something you'd want to pay down so that you don't limit your returns going forward. So now we get into two key concepts of kind of why you should be starting as soon as possible and how this is really going to work in your advantage to help you build wealth over time. The first one is going to be the time value of money. This is essentially just the concept that $1 today is worth more than $1 in the future. If I were to ask all of you if you want $1,000 right now or $1,000 1 year today, raise your hand if you would take the $1,000 right now. And then raise your hand if you take it in a year from now. Okay, so an overwhelming majority decided to take it right now. That's kind of just part of human nature. We're pretty impatient people. We want what we can have and we want it as soon as possible. But there's also some underlying factors, such as opportunity cost. If you've taken an econ class, you understand this concept as being the value of the next best alternative or what you've given up. So if you were to choose to take that money in a year from today, you give up the potential of being able to accrue interest and earnings on that $1,000 so that it could be worth more in that year time span. There's also the concept of inflation. Over time, our purchasing power decreases. As you all are pretty well aware of, if you go to the grocery store, if you go to get gas, you're just not able to buy as much as you used to with this fixed amount compared to maybe even last year. So taking that money in the future, you're automatically decreasing the amount you can purchase.
And kind of going off of what Hannah said about inflation, compounding interest is a very powerful thing in my opinion. And to kind of visualize that, I'd like to change the next slide.
Before we get into
before we
the
get
next slide, there is just one thing I want to mention about compounding. If you're not too familiar with the topic, again, it's essentially interest on interest. And a nice visual or analogy that I like to refer to is snowball effect. If I were surrounded by snow and were to pack up a snowball, that would be putting in the work to make that snowball. Now I could continue to do that in order to grow the snowball, aka grow my buns. Or I can look at this nice snowy mountain and just simply push it down the hill. And as it goes down the mountain, it's going to increase in size and speed. And all I really had to do was take that initial push. So compounding is essentially the fact that that snowball is accumulating in size without me putting any more snow myself on to make the snowball bigger. Is essentially the concept.
And here's a pretty graph to put it into perspective. So I started off with $20,000 in a fund, and pretty much you're going to have 3% taken away each year due to inflation. And then if you were to take that all the way down, you'd end up with, I think, with after 30 years, $8,020. And within that same 30 years, if you were to invest that into a typical, diversified portfolio, you normally gain 10%, but let's take away another 3% for that inflation again. So 7%, you would end up with $152,245. To me, that's just amazing. And to kind of make compound interest even more interesting, if you were to take, let's say you offer somebody $1 million in 30 days, or 1 cent doubled every day for 30 days. Well, that 1 cent doubled every day for 30 days would be over $5 million. So just the amount of the power of compound interest really plays a huge role in being able to understand that, because who would want to pass up on that difference? I think it's easy to think about, oh, money now is really attractive. We want to be able to spend the money that we earn, but later on in life, you want to set yourself up for success by doing this.
So now that you kind of understand the benefits of investing, before we get actually started investing funds, it's really important to kind of think about your goals. And this is where an investment policy statement will come in. Now, typically, this is a document drafted by a financial professional, portfolio manager, a financial advisor for their client. But many of the key concepts still really hold true for individual investors, because I believe it's kind of instinct for us to, when we think of investing, automatically jump into the question of what we should be investing in instead of what we should be investing for. By defining those goals, you can set yourself up for greater success by being able to determine things such as your time horizon. If you're saving for maybe something in 5 to 10 years, like a car or house, or something far, far away like retirement, which I know is kind of scary for some of us students to think of. But those are going to have very different methods. Those are also going to play into the amount of funds you're going to need to reach these goals. There's going to be calculators out there if you want to specifically calculate the amount of funds you're going to need for retirement or for our house. Any of those things, you can just Google those so that you can be well informed of what funds you actually need to set aside. And then also keep in mind the amount of returns you should be expecting with your investments. Returns and risks are going to go pretty hand in hand. So if you want to scan this QR code, it will take you to a risk assessment from the University of Missouri. This is just essentially going to give you a guide on what kind of investor are you and what risk tolerance you're going to be able to stomach through market volatility and losses. This is going to lead us into asset allocation. Essentially, it's just saying, how are you going to divide up your money into your various investments? Some common ones here that we'll go into more detail later include cash and cash equivalents, equity, stocks, bonds, derivatives, and alternative investments.
And then how to start with your investing. So you want to first open a brokerage account. This is for the short, intermediate term investing. And then you're next going to go into retirement funds. So those will be tax advantage accounts, whether you get taxed now or later, depends on what account you choose. And then for brokerage accounts, what to look for. I've used almost all these right here. Personally, I love just almost every single one of these. I've had that experience with one, but you're looking for a few things. You're looking for zero account minimums. And I would say like fees on trades is huge. If you're working on short-term investing, if you're a short-term investor or you're a swing trader, you're making maybe a few more trades than you would if you're just in a long-term account, just holding and buying. So look for zero account minimums if you get more into the short to intermediate terms. And then look for transparent commission fees. I've had one experience where there was some shadiness going on where they had gained more funds. They transferred funds from one account to the other because they were incentivized. So check those incentives through just looking at their fees and what they're given based on that. And then diversify your investment options. So making sure that you're not putting everything in one account or one kind of account or even one company. So you want to kind of diversify across all companies. And then find a reliable online mobile access app. So digitalization has made us made this very accessible for everyone. And if a company does not offer that, I believe that they should be open.
So now moving on to retirement accounts. Like I said earlier, for many students in the room, it may seem like something way, way too far in advance to be thinking about retirement. But hopefully after our conversation of time value of money and compounding, you understand that by investing now and starting early, you can grow your earnings much, much more than if you were to start later, even with the same initial investment. So when we think of retirement accounts, maybe some of you have probably heard of a 401k. This is just an employer sponsored account. It's also, you'll hear about a 403b. That's what's offered here at Lindenwood for not-for-profit institutions. Essentially, with these accounts, employers will set up individual accounts for their employees to invest in, and these contributions will be taken out of their paycheck. So like I said earlier, these are tax advantage accounts. So by taking it out of your paycheck without having to pay taxes on it, by paying taxes on it now, you get that upfront tax break so that you, one moment, I accidentally messed that up. So essentially, the tax advantage with this account comes because you are getting an upfront tax break by reducing your taxable income. So you will be paying taxes later on. There's also another key concept to look for when you're looking at your 401k plan. You'll see it in your benefits paperwork, something of like a company match. This is something you definitely want to take note of because you essentially kind of have some free money on the table. For example, if you were making $50,000 and the company was offering a dollar-to-dollar match for up to 5%, if I put $2,500 in that account, my employer is going to match that to $2,500. So now I have $5,000. That's a guaranteed 100% return, which, as we said earlier, it's very difficult to find that type of return in the market. So if you see that, that's definitely something to look out for and just be aware of as you start investing.
And something kind of funny story on the side of this is that with IRA accounts, you actually, when you put money into the IRA account, you do have to choose what stocks they go into. My mom, she's worked at Fox News, Fox Industry for 28 years now. But her first 5 years, she just put money into the IRA and never really chose which accounts to put it into. So just be aware of how those work as well, just making sure you're choosing which asset classes you're going to.
Yeah, so going into the IRA, of course, not all of us are going to have full-time jobs with benefits. Or if we want a little bit more flexibility than what we offered in our 401k plan, there are individual retirement accounts or IRAs that you can look at. Again, these are tax advantage accounts. The two key ones here are going to be Roth versus traditional. And again, it comes down to, do you believe you're going to be in a higher tax bracket now or later? That's going to help you determine where you can get the most tax savings between the two. With a Roth, you're going to get the tax break with being able to make tax-free withdrawals in retirement. And with traditional, you're going to get that upfront tax break like with 401k. Another thing that kind of is getting ahead, but I just wanted to mention here so you have it in mind, with a specific investment option offered with a lot of 401ks is going to be a target date retirement fund. This is going to automatically configure an asset allocation considering how far away you are from retirement, and it will rebalance itself over time so that you don't have to worry about making those decisions about being a more conservative investor as you get closer to retirement, just to make sure you have those funds and you feel secure in your financial future.
And then, so next we have dollar cost averaging. So I just want to ask a quick question. Has anyone of the students here ever done investing at all? All right, good. What's your experience with that, if you want to share?
My dad's a financial advisor, so I just.
Oh, so you just been around it.
And then I've also done like, I guess Acorns, I dabbled in that a little bit, but it's just sitting there.
And so one of the, I think, things that I used when I first started investing was dollar cost averaging. I made the mistake first of just putting all my money in, and then I would realize, oh, the stock went down and I wasn't able to have funds to buy into to average out my costs. So dollar cost averaging is taking your full funds and then slowly over time buying that stock, whether it goes up or down. If you're a long-term investor, this really isn't going to matter. But if you're in the short to intermediate term, you're going to be able to average out your costs much better than if you were just putting it in. And there's many places that are good for this. So you can just do Acorns, which is a really good start. I started off with Robinhood, so that's my first experience with that.
So now that you deposit your funds, as Greg made that illustration earlier about, it's really important to actually invest those funds. Some people may just believe by putting the money in the account that your investments are already working for you, but that is unfortunately not the case. So you really have two main decisions to consider here is if you want to be an active investor or a passive investor. Active investing is a more hands-on approach, buy low, sell high. You're putting forth a lot more time and effort, or you're paying someone to put forth the time and effort to manage your funds for you. This ties back into that concept of opportunity cost. Do you believe the time and effort you're putting in is going to outweigh any returns you could get passively? So an active investment style is really for those of you who believe that you can beat the market by picking your securities and actively manage that fund. Passive, on the other hand, is a buy and hold strategy. This is for long-term investors and especially beginner investors. So like we said, tracking index funds, those are going to be a wide range of companies like the S&P 500, for example. There's index funds that track that performance of the 500 largest companies publicly traded in the US. So that automatically just gives you a diverse option of investments to buy and hold for the long run so that you can maximize your returns.
And then what can you invest in? So you have common asset classes, cash and cash equivalents. These are just readily available bank accounts and that kind of stuff. And then you have access through high yield savings accounts. And then next you have equity and then bonds. We've already kind of touched on equity. That was just typical stocks and stuff. And then bonds represent pretty much a loan made to, let's say it could be the government, it could be a corporation, and they'll repay that over time at a pretty low yield, but it's guaranteed money that most of the time is guaranteed. And that's really kind of the safest option of that. And I think we have a chart that's coming up here next to kind of explain that. Actually, we have derivatives. So derivatives, I think of this way. So if you have, let's say, take your favorite sports team, you look at their statistics and you can kind of see the probability of winning. And then you are making an educated guess on whether that team's going to win by putting money into a bet or something of that sort. And that's kind of what derivatives are. So you have like a stock and you pretty much have an educated guess on whether they're going to be successful or not. And that's the derivative market. It's really complex. If you'd like to learn more, just Google search. There's some YouTube videos about this that I really enjoyed. And then you have alternative investments. So you have hedge funds, real estate, commodities, cryptocurrency. We've talked about a few of these, I think, in previous lectures here. And we won't really go much into those, but if you are interested, just look into them on your own, and it's pretty easy to access this information.
Yeah. And as beginner investors, you're mostly going to be dealing with the three previous asset classes we discussed of bonds, equity, and cash equivalents. But these are, again, just something to definitely look out for if you want to do more research.
And then starting off with the risk. So you have expected risk. If you're going to have a high risk, you expect a high reward. If you were to have high risk and a low reward, that's not it's really smart to take on. So you're starting with cash equivalents. That's going to be like your low yield savings accounts, just your general account. And then you have bonds, which is kind of in the middle. Those are just really safe. And then kind of real estate, commodities, and stocks. Stocks can be really complex because it could be really high risk or it could be really low risk. Just depends on which kind of stocks you go into. If they're a small market cap, you're going to have a lot more risk in that.
Exactly.
Yep.
And going back to our conversation about asset allocation, typically, if you're a more risky investor, that's when your investments are going to be more on this high side of the chart. While if you're a very conservative investor, you're going to focus your investments with a lower potential return and a lower potential risk. So that's how it can kind of vary across asset classes. So now talking about risk and diversification, of course, you can see that all investments do carry some degree of risk. This can vary based on how quickly you can convert it to cash, the kind of returns you're expecting from this investment, and honestly, just the safety of it. Cash and cash equivalents, you can keep up to $250,000 in an FDIC insured account. That's guaranteed money for you. So that's going to be very low risk compared to other options where you could lose all of your money. But considering that fact, there are methods to help mitigate that risk. The key one being diversification. Essentially the concept of just don't put all your eggs in one basket. It is a process that includes a wide variety of investments within a portfolio that focuses on the fact that hopefully if you have that wide variety, if you have investments that returns are driven by different factors, even if some are doing poorly, there will be others that are performing better or just as well that will help to offset any risk and any loss of your principal.
And then so we have asset classes. We can kind of talk about that, or we've talked about that previously, but I think I'd like to touch on market capitalization because I mentioned that previously where, well, maybe you guys don't know, but market capitalization is pretty much the value of a company. So if you have a company like Apple, they're a $600 billion company or maybe reaching $1 trillion by now. And then you have small market caps, which maybe you like take, for example, Clayco, it's $4 billion. If someone was to take out 1 billion in funds from Clayco, a $4 billion company, that's 25% of the company wiped out. So they're more volatile with the smaller market caps. So as you get into larger market cap, you're going to have more stability. So you want to kind of diversify your portfolio across those stocks accordingly. So put a lot of maybe more into the safer route, or if you feel like you want to take high risk and invest in a company that's starting up and coming up, you're gonna have those lower market caps to invest in. And then you have geography. You can spread across different cultures. That's really important. There's not much change between the United States and Europe. So if you were to invest into like a different geography, maybe Japan or an Asian country or something like that, if you were to diversify those funds into that. And then you have sector and industries. So sectors is the overarching thing of industry. Industry is below that. So take, for example, you have gas and oil, and that's within the energy sector. There's many things that you can kind of see in the cycle of industries, and you're able to kind of invest in things that will kind of balance each other out throughout the year or just the cyclical cycles of things.
So talking about all the diversification, of course, is a great method to reduce risk, but it can be kind of overwhelming thinking about all the factors you have to keep in mind in order to keep your drivers different of your returns. So there's definitely investment companies out there, such as mutual funds and ETFs, that pool investors' money together and invest in a variety of stocks, bonds, and other investments that automatically offer you that diversification. An example of mutual funds that's not necessarily financial is if you wanted a meal tonight, you could either be an individual investor, pick your own securities, aka go to the grocery store, find the ingredients, find the recipe, figure out the proportions of everything to make a great tasting meal, or you could save yourself some time, money, and effort, and maybe even get a better meal by going to the restaurant and just order your favorite food and have it served right to you. So the mutual fund and ETF is going to act kind of as your restaurant with those diversified options available to you.
It's like carpooling for finance.
And so these are going to be professionally managed, and they can range in how active or passively they are managed. So you're going to have some that are more so aimed at beating the market, while others are going to be heavily focused on index funds and making sure they're in alignment with market returns.
And I've kind of previously mentioned this story, but whenever you're looking at professionally managed accounts, make sure the fiduciary duty is strictly for you and not in their interest. So I had someone that was like, all right, well, I think this account will make more sense if you put your money into this account. And they switched, and they gained they made money off that exchange and that transaction without me knowing. And it was not really in my benefit to do so. They still made money, but it wouldn't have made as much as they just kept it in the place it was. So just be aware of how what their duties lie to you or to the company.
So that kind of brings us to our conclusion. Of course, you're not going to learn everything there is to know about investing in the short span of this presentation, but hopefully you've been introduced some guiding principles and information that will help you along with your journey. One quote that I really like is that the perfection is often the enemy of positive action. If you think that you're going to start out and be this perfect investor, you're going to psych yourself out and just get so caught up in the details that you won't even get started. And as shown in this presentation, getting started is really going to be in your best interest so that you can take advantage of compounding and all the other things that investing can offer you. Just some like leaving notes just to really hone in these points in is going to be along those lines. Time in the market beats time in the market. Don't get so stressed up on those things. Like many things in life, you're going to learn as you go. Make sure you have those goals defined before you start investing so that you can really make your money work in the best possible way for you. And please, 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 please do your own research. There is so much to learn out there. And it's really going to cater to each of you depending on what your goals are, where you're at in life. So if you can do your own research and make financing and investing decisions that you're comfortable with, your investing journey is going to go much smoother. And of course, diversify. That's a really key way to help mitigate risk and make sure you're earning stable returns over time.
And it's kind of just finally conclude on that as well. First off, just remind you, always get your spending in order first. I think it's really important that you are responsible first for just without anything investing, just your own daily day-to-day spending and making sure that you're able to set a good base for your investing activities. And from there, you're all set to go.
So we also have some additional resources from Fidelity and the SEC about saving and investing, if you want to look into those. But of course, there's a bunch of different resources out there. These are some starting points that I thought had some really good information for you all. That, does anyone have any questions?
Now, let's open up a question.
Anna?
How much money do you need to start investing?
So you really don't need any set amount. However much money you have to start investing. Luckily, with, as we discussed, there's many accounts out there with 0 account minimums. So the barriers to investing are very, very low right now. So if you have the extra cash, it is a great time to get started.
It will depend on if you, so say for example, Robinhood, they buy the stocks, but you don't own them if you're putting in, the money for it. Because you're not buying a full share, you're buying partial shares. That's a shared account. So take, for example, if you have TD Ameritrade, which is now Charles Schwab, you need a 2,000 account minimum to get started into that, because sometimes shares can be $500, $1,000 each. So yeah,
It is really just going to depend what you want to invest in.
so always just start off with the little tiny amounts and just see where it goes from there. Like Acorns was a great start for him, and it's a great way to kind of just get interested in this thing and get a feel for the pulse of the market.
You gotta have more questions than that. Come on.
Yes.
So besides like cryptocurrency and NFTs and stuff, what are some of like the new up and coming ways people are starting to invest in things outside of the stock market and real estate?
I mean, I've seen current trends where I think that as we go forward, people want to take investing into their own hands. And I don't think there's really much anything new that's coming out as far as investing that really isn't scammy. A lot of people hear cryptocurrency think it's a scam. I think there's a lot of cryptocurrencies that are. But I personally have dabbled in cryptocurrency. And as long as you're responsible, not just dumping almost all of your assets into that, maybe 10% of your funds, it's a great way to maybe diversify your portfolio even more. But I haven't seen anything new that is investment worthy. I think the best thing I personally believe, every millionaire that I've talked to or encountered, real estate is really big, and it's something that I maybe look into more. So, yeah.
There's a question online about people in the room are thinking. They asked, do you recommend any investing platforms for a student out of high school?
I don't know, can we
So
recommend it?
we're not necessarily going to recommend any specific platform. There are going to be some that we mentioned today that kind of meet that criteria. So if you look back through that criteria that we mentioned and kind of need to analyze what works best for you, there's a lot of resources out there like NerdWallet that will automatically like give you reviews of how other people use that platform and kind of give you their pros and cons. So that is going to be one that's going to require a bit more personal research.
Maybe I'll ask it this way. Could you share some examples, perhaps some common?
Yes.
Popular platforms?
Kind of popular one for if you're just starting off would be Robinhood, Acorns, as they don't require a very large initial amount, and it's really easy to get into their portfolios. They have a lot of assets to look into, and they have some of the largest market caps, so it's really stable too at the same time. So they're not going to focus on small market caps. You're going to see market caps on those apps.
Yeah, and the ones we had listed, Fidelity, Charles Schwab, those are all very long-standing ones. A lot of them have good research and a lot of good resources for you as
But
well.
those do have a very large account sometimes.
Sometimes you can get started for zero for some of them though.
Yeah.
So it really, again, goes back to doing your own research.
Just encouragement is the best resources you have are probably your parents. And so lean on them. And there are ways to automatically save. Grant and I, Dr. Black and I are economic educators. Saving automatically is one of the best ways to get yourself in the habit of saving. And so there are tools out there to help you, Chime, Digit, Acorn, and there's a list of others. Work again with your parents and find ways to get yourself into that habit, because just saving as little as $3 a day can put you in a very strong position on retirement. And according to some estimates, it could almost land you on the $1 million mark.
Great advice.
Except for the past year.
Yes, again, there's going to be volatility in the market. Looking at the long run.
If your parents aren't good with money, always seek out professional help.
Other questions? We have lots of time, so feel free to ask questions. Yeah.
When you were talking about the emergency fund, there was a thing about, well, you should like do like 3 to 6 months.
Yeah.
That, how do you figure out like what that amount would be based on?
So it just took me a while to get my spending down. It's really easy to kind of have a budget per month. The best way that I can suggest, I've seen it work with other people as well, is break down how much you can spend per day. So break down your budget per day, and that really puts in perspective. Oh, I spent this amount of money today, and that was way over my budget for today. And then maybe you can even work on saving. Say I didn't spend any money today, I'm gonna roll that over to tomorrow, keep on rolling that over tomorrow, and then kind of see how that works. So that's the best way I personally, and know many other people have got their spending under control, is break it down by how much you can spend per day. And it's really easy to digest that rather than just look at the monthly budget, because we all lose track of our budgets, and it's really easy just to kind of just go and buy something and you realize, oh, wow, I spent a lot of money on this, these purchases today. And then just figure out if you can't do a daily one, do a weekly one. So just keep on breaking it down to smaller chunks and then figure it out from there.
I'll add this. So an easy way to kind of think about, right, how to build an emergency fund. If you take whatever's easy, kind of what he's saying, to think about your spending, whether that's a week, a month. A lot of people do this in a month. Kind of track your spending. So where your bills, think of the things that are fixed expenses. Perhaps that's tuition or rent or insurance, things like that. Then add up all the variable kinds of things that you spend money on. So, hey, what am I spending on food and gas and entertainment and all of that? See what that looks like for a month, and then track that a few months. And then you have a pretty good idea of, hey, this is sort of what I need to live every month. And obviously you could adjust that. You were finding yourself in situations where, yeah, I've got to overdo it.
Yeah.
But that gives you then a sense, hey, what would it cost me to kind of survive for several months if things went bad? And then just sort of multiply that out. Hey, if that's, $1,000 a month or $2,000, okay, multiply that out by 3 or 6.
And this
And
is
that's
becoming
kind of
increasingly hard, yeah.
Yeah,
So
it's hard to, you're not gonna set that up right away, right? You're gonna build that up, but that's sort of a longer term goal that, hey, I want to establish a really well-founded emergency fund.
And to add on to that, we co-teach a making bank first years. And some of the students there were going out to eat instead of using their meal plan. So every time they felt that impulse, they would take the money that they would have spent on eating out and they placed it into a savings. And so they came up with that. So those are interesting ways. Talk with your friends and brainstorm and hold each other accountable, or encourage each other to stick to a budget, so to speak. But it's not all or nothing. It's a gentle kind of like step into this lifestyle. You can do it.
that can also keep it too. So
Yeah.
Rocket Money, I use Rocket Money. I think that's really cool. I've used other ones as well. They'll just notify me, hey, you spent this amount this week, and then you can kind of see where you spent that money to, whether it's food, retail, or any of those other sectors.
Here's another online question just popped up. What's your take on this? Should millennials invest in Roth instead of traditional IRAs based on their current tax brackets, given the amount of national debt? And we could have any faculty chime in if you'd like. Have a thinking about this question.
Yeah, that may be a better, give some better advice from more experienced faculty members if anyone has some input.
Their taxes go up.
So,
Maybe explain the difference between traditional and Roth IRAs.
okay.
And what they.
Yeah.
Yeah.
Okay, so essentially the difference between Roth and traditional IRAs is where you're going to be getting that tax advantage. With a Roth IRA, you're essentially expecting to be, well, why you would choose to invest in a Roth IRA is if you're expecting to be in a higher tax bracket later in life, like me personally, and with many students. I'm not making that much money right now. I really hope I'm in a higher tax bracket later in life. So I personally choose to invest in a Roth IRA. So really just kind of looking at where you're at in your current tax bracket and your expectations for your income will be going. Traditional, on the other hand, you're paying taxes, you're getting that upfront tax break now. and then thinking you're going to be in a lower tax bracket later in life. So that's kind of like the difference between those two and why you would choose to invest in one over the other, purely for how much more you can save in taxes.
There's currently a cap on how much you can put in a Roth IRA.
Mhm.
It's a general rule of thumb, if the government's capping what you can do, it's probably in your advantage. There's a reason they're capping your ability to use that.
It's very
It's
good.
a general rule of thumb, but taking advantage of the corporate match in the 401k is probably step one because of that 4% return. After that, as long as you're betting that your tax bracket is going to be higher, future than the Roth IRA. But take advantage of the corporate match. It's amazing the number of people who either don't fully hit the match or don't understand it at all and don't put money in their first couple of years because they're looking at their annual earnings and they're going, well, I'm only making $35,000 a year. I can't afford it. Well, you're giving up, $3 or $4 grand that you would be putting aside by not doing the match.
Any last questions?
Any other questions online? Second to respond.
But thank you for vouching too for helping out in those last few questions. Always great insight.
All right, if there's no questions, everybody just hang on a second. I'll be right back to that. Well, let's thank our speakers first of all. Let's just say. You guys did a phenomenal job. This is exactly what we were looking for. This was down to earth, practical, and really great takeaways and information. So be on the lookout for things like this coming down the road. So this is the kind of thing that we want to provide to help empower you in enriching your lives. So if you ever have questions or ideas for things like, hey, I'm really interested in this, or hey, there's a group of us that we'd like to learn more about this, definitely reach out and let us know because we would love to organize events that matter most to you. Just as a quick takeaway, I know I have every week I've got this commercial. If you're interested in learning a little bit more and just sort of some good solid foundations, thinking about establishing, an understanding of your personal finances, Common Sense Economics is a great place to start. Amongst all the other kinds of resources that we've shared, you can do a quick kind of online little course that you can earn a badge in. So just scan that code and to check out the website, and you can sign up for free to do that. Especially for you students that are here, but everyone is welcome to this. Hey, we want to give you guys a chance to give some feedback on today's event. You can go to that link or just scan the code while you're sitting here. The important thing for students that are getting any kind of extra credit or some kind of incentive like that, you are required to do this exit survey. So in that survey, you're going to report which instructor is providing that incentive for you. So make sure you complete this. So you're going to miss out on that opportunity if you don't complete the exit survey. See, well, that's kind of it. Let me that's what I was going to say now. Maybe that's a good that's the way it goes. It's time to be done, isn't it?
Bransetter, so that's
Any final questions? Well, I just want to thank everybody for being a part and participating this year. And I want to thank all the speakers that we've had all month long. We've had a great lineup of folks, and I think we've learned a lot around a really diverse amount of topics. And so we look forward to bringing this back to you in the future. And if you have any questions, don't hesitate to reach out. Yes.
Can you leave the exit survey?
Yes, I can. I can definitely. Oh, I know what I was going to say now. So that triggered it. For any of you, especially those online and those sitting here as well, if this was the first event perhaps that you went to, on the website, the Get Money Smart at Lindenwood website, there are recordings of the past events. And so you can go back not only this month, but actually you can see the last year's as well. So you can go watch those and get the information from those. So go explore all kinds of different topics. So definitely check that out as well. And it's the same as where you went to register for the event. That's where kind of all those links are. All right. Well, thanks everybody. Enjoy your afternoon, and we will see you soon.